let's talk about what causes deals to not close. We're going to talk today about the 5 top deal killers in lending. So let's get into it. Tara Ryan here with Fairway Mortgage, and the number one deal killer that I see is investment property purchases where the buyer is trying to use gift funds. Guys, gift funds are not allowed on an investment loan. No way, no how, for a conventional investment purchase. So that can happen. For example, let's say there's a husband and wife buying an investment property. Husband is the only one on the mortgage, but it turns out all the funds are in an account just in wife's name. That is not the buyer having the funds, and it technically would be gift funds and not allowed an investment property. Sometimes you might find that there was a large deposit, and that large deposit was a gift from a family member to help buy this investment property. So lenders miss this all the time. We know to look for it. No gift funds on investment property. Number two, folks that are self-employed whose income is declining or who don't report enough income. So maybe their accountant is super aggressive with write-offs, and so what their net income is, which is what we lenders have to use, is very different from what the buyer is experiencing in real life. Okay. And so if you don't have a great lender, he's going to dig into that tax return and kind of will go off just what the buyer typed in their income is. And we know many lenders right now are giving out pre-approval letters just based on what the buyer types in. They're missing the mark. We've got to dig into that tax return. And oftentimes we need 2 years of taxes. And if that income is declining, okay, if it's dropped more than 20%, sometimes you can't do the loan at all. All right, we have some workarounds. We're going to try to find a way to do it with just 1 year taxes, for example. And so we're going to work through that on our end. But for you, be aware, declining income can be a problem. And hey, the corollary is sometimes the lenders don't even bother to do the work to understand that the buyer is self-employed. Sometimes buyers will say, oh no, I've got a W-2, because they own the business, but they pay themselves a salary. And so they do get a W-2, but it's from their company. Okay. So that doesn't work. You're still self-employed, even if you pay yourself a W-2. And as a lender, we look at the addition of your business income or loss and whatever you paid yourself. Okay, so think about it. If you 100% own the business, you could write yourself a really big paycheck and have a really big W-2, but maybe your business lost a ton of money. Okay, so it all adds together. So we're going to look at the business income or loss combined with the W-2 income. And a lot of lenders just miss the boat altogether and don't even realize that their buyer is self-employed until it's too late. Number 3, undisclosed debt. So this would be where the buyer doesn't tell us that they have a IRS payment plan, for example. Maybe there's child support that they neglected to say on the application. Sometimes there's only so much we can do on this, right? If the buyer doesn't tell us the truth on the loan application. But we want to find it as the loan officer before an underwriter does. So how could an underwriter find it? Well, maybe on a bank statement. There's an IRS monthly payment, right? $200 a month going to the IRS. That's what's going to clue the underwriter in to know that there's an IRS payment. So we, as a loan officer, need to find that at pre-approval. Number 4, a condo project being unwarrantable, or for some other reason we can't lend in that project. That is a big one, and you guys know I talk a lot about condos. Be on the lookout for another condo CE class. You get all that info. And number 5, something happened to where the buyer no longer meets the debt to income requirements. Most often that would be something increased the monthly payment on that property that wasn't known up front. For example, lenders all the time will pre-approve somebody and get them out shopping for $400,000 because that's what the letter says. But that's not how we qualify buyers. We qualify on the monthly payments, right? And so you think that they can go up to $400,000, but the lender wasn't accounting for that they're looking at a condo with a $500 a month HOA fee. Okay, or maybe a new tax bill drops. So this time of year can be a little wonky in Atlanta. So we're qualifying the buyer for that home based on the current tax bill, but then the tax bill for 2025 drops and it's higher, and it can increase that monthly payment and therefore increase the debt to income. So that's something we're looking for when we're in this fall period. We're making sure that we're not right up against the debt to income limit if we know a new tax bill could drop prior to closing. So that's it. That's the top 5 deal killers that I see. How do I know? I get the phone calls when deals are going south and you guys need a fixer, somebody with a SOS, save our sale. We love taking care of clients in that situation. We love helping get somebody back on track when they've had a bad experience with a lender. But more importantly, we'd love to take great care of them from the start and save you and them that hassle. Give us a call. We'd love to help.